the daily insights that matter. We begin today's DITM by talking about IMF, who has lowered India's FY23 growth forecast to 6.8%. Now, the International Monetary Fund, in its latest World Economic Outlook report, cut India's gross domestic product, or the GDP growth forecast for FY23 by 60 basis points to 6.8%, citing the impact of external headwinds and weaker than expected second quarter growth. Now, India's GDP released in the month of August showed that the economy grew well below the expectations at 13.5% in the April to July quarter due to the dismal performance of the manufacturing sector. While the IMF has cut growth forecast for FY23 substantially, that for FY24 was left unchanged at 6.1%. The sharp cut for India comes even as the global growth forecast for 2022 was left unchanged at 3.2%. However, US is now seen growing at 1.6% in this calendar year, which is 70 basis points lower than what was predicted in July. The IMF forecast also follows a slew of downward revisions in growth estimates by other agencies. The World Bank last week lowered India's growth forecast to 6.5% for FY23, while the Asian Development Bank and the Reserve Bank of India have already cut the projection to 7%. The report highlighted that the global economy continues to face challenges, including inflation, tighter financial conditions, Russia's invasion of Ukraine, and the lingering COVID pandemic. The data also shows that much of the contraction in growth will be seen in the advanced economies like US and the UK. Now, there will always be the classical debate of looking at a technical definition of how people are classifying a country as being progressive or as being in recession. And the typical economist behavior will be to cast aspersions on the growth ahead, to leave investors with a note of caution, and to bring about every possible risk that may apply to any given nation. While it is true that on the emerging economy side, the currency-based pressures, the inflationary environment, the geopolitical crisis look inflamed, the recessionary fears are not only pronounced but real as well. Now, in the similar tone and breadth, the Indian economy, which is expected to now have a revised GDP growth of 6.8% for this fiscal, would still mean that it would have a very progressive tone to this year's growth numbers as compared to that last year. Now, in the global scenario that we are in currently, when things get better, and the question here is not if the things will get better, because the underlying operative word here is when things get better, as such inflationary pressures will ultimately be tamed, interest rates will ultimately take the better of, the currencies will eventually stabilize, and the economies will eventually move on. So when this happens, the 6.8% growth will certainly be a number that will resonate with the long-term growth prospects of what this nation holds for every citizen. As of now, everybody is being weighed on the same scale. And the scale says that the pressure side on one end is very commanding from an inflation, from a forex reserve, from a Russia-Ukraine crisis perspective. And this affects the GDP growth numbers not only for India, but even to the economies like the US, the UK, or China, which are currently looking at testing times. So if you go by the gloom of what you're seeing, then you would never be tempted to invest in the markets. But as they say, in times when there is a broader spread panic, which is short-lived, lie the best opportunities. So if this is not a direct advice for you to invest, it is certainly not a direct advice for you to sell either. Now, a sharp rise in demand for credit, higher consumption during the festive season, and the dollar sales by the RBI and the forex market have led the liquidity in the banking system to tighten sharply. Now, in September, liquidity in the system slipped into deficit for the first time in 3 years. In October, the system slipped into a liquidity deficit for the first time. Now, according to RBI data, the central bank infused 8,764.43 crores in the banking system on Monday this week. Now, an infusion of funds implies that the liquidity is at a deficit. In September, the RBI absorbed liquidity worth around 91,000 crore rupees, and in the month of October until Monday, the RBI has absorbed 90,000 crores worth of liquidity. Now, for banks, liquidity tightness means that the banks will be under additional pressure to raise deposit rates to fund high credit growth. The latest RBI data showed that as on September 23rd, the bank credit grew at a 9-year high of 16.4% year on year, while deposit growth lagged at 9.2%. So if you look at the total amount of credit that has been given and compare it with the growth in the deposits, it's far higher. Now, one of the reasons that the deposits have not grown at the same level is that the consumption has grown very well. Now, this can partly be attributed to the inflation which is seen by higher GST collections. So there have been some compromises that the individuals have made in their individual savings. Additionally, since the RBI commenced its rate hike cycle on May 4th, banks have been quicker to pass on the rise in the rates to loans than to the deposits. Therefore, the banks are now facing pressure to raise the deposits, which could be done by offering higher interest rates. Now, given the strong demand for credit, until the deposits rise, it can become more challenging to access credit, especially for weaker entities. And this can potentially slow down credit growth, which will in turn impact the economic growth. So what does all of this news mean for you? India's GDP growth downgrade is largely due to weaker than expected outturn in the second quarter and more subdued external demand. That being said, almost every country is slowing. In that context, India is doing better and is in relatively brighter spot compared to the other countries within the region. The downgrade will definitely have an indirect negative impact on you for time being. The bank's liquidity turning into a deficit is an indirect negative too at this time, as it would impact the overall credit growth until the deposits rise. That said, most banks have started raising their deposit interest rates as seen over the last 2 years. While I say this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.